AI stocks are exploding again. Chip companies are rising. Data center companies are rising. Every week, another headline makes people feel like they missed the biggest opportunity of the decade. And now one question is everywhere. Is it too late to invest in AI? But that question can be dangerous, because it makes you believe there are only two choices: buy right now or be left behind forever. The smarter answer is not that simple. When prices rise fast, fear takes over. You see people celebrating gains online. You see charts moving higher. You hear stories about someone who bought early. Then your brain whispers, "Why am I still waiting?" That feeling is called FOMO, fear of missing out. And FOMO has made investors buy great companies at terrible moments for decades. The goal of this video is not to tell you to chase AI stocks. It is to help you decide whether AI belongs in your plan at all. First, understand why AI stocks are moving. Artificial intelligence is not just one app, one company, or one shiny chatbot. It needs powerful chips, memory, networking equipment, cloud servers, electricity, data centers, and software. That means real money is being spent on real infrastructure. This is why the AI story has become so powerful. It is not based only on excitement. There is genuine demand behind it. But real demand does not automatically mean every AI stock is a smart buy at every price. Here is the mistake many beginners make. They see a stock going up and assume that proves it is safe. But a rising price does not tell you what happens next. A company can be excellent. Its technology can be important. Its profits can grow. And the stock can still be overpriced because investors already expect too much. The market does not only reward good news. It rewards news that is better than expectations. That difference matters more than most people realize. AI may be a real long-term revolution, but markets can still get ahead of reality. Think about it like this. A new restaurant can be amazing, crowded, and growing fast. But if investors pay a price that assumes it will become the biggest restaurant in the world, even good results may not be enough. That is what makes hot markets risky. The company can win. The technology can win. And a late investor can still lose money because they paid too much. Another important point: AI is not one single trade. There are companies making chips. There are companies building data centers. There are cloud companies renting computing power. There are software companies trying to turn AI into useful products. And there are companies that may benefit from AI without being called AI companies at all. This means buy AI is not a complete strategy. You first need to understand which part of the story you are actually investing in. The biggest danger is putting too much money into one exciting idea. When a theme becomes popular, it can feel like diversification is boring. But boring is often what protects you. A portfolio should not depend on one company, one sector, one headline, or one prediction. AI could continue growing for years. But no investor knows exactly which companies will dominate, which companies will disappoint, or when the market will change its mind. That is why concentration can become painful very quickly. So is it too late? For someone trying to make a quick profit by chasing the latest winner, maybe the better question is, why are you buying? Are you buying because you understand the business? Or because the chart made you nervous? If your reason is fear, slow down. A good investment decision should still make sense on a calm day, after the exciting headlines disappear. Never let urgency make your financial decisions for you. Your timeline changes everything. Money you may need next year should not be treated like money you can leave invested for 20 years. AI stocks can move sharply in both directions. That may be acceptable for a small part of a long-term portfolio, but it can be dangerous for money needed soon for rent, education, a home, or an emergency. Before asking, will AI go up? Ask, when do I need this money back? Before taking more risk, protect your foundation. Do you have emergency savings? Are high-interest debts under control? Can you handle a market drop without selling in panic? These questions are not exciting, but they decide whether investing becomes a long-term advantage or a source of stress. A strong emergency fund gives you time, and time gives you the ability to survive market volatility without making desperate decisions. A smarter way to think about AI is not, should I put everything into it? Think instead, how much AI exposure fits inside my total plan? For many investors, the best answer may be limited exposure inside a diversified portfolio. That way, you can participate if AI keeps growing. But one bad quarter, one earnings disappointment, or one market correction does not destroy your entire financial future. Participation is good. Overdependence is dangerous. You also do not need to guess the perfect day. Trying to buy at the exact bottom is difficult. Trying to sell at the exact top is even harder. Instead, a regular investing schedule can reduce the pressure of one huge decision. You invest a planned amount over time. Some purchases happen at higher prices. Some happen at lower prices. But your financial future is not controlled by one dramatic headline or one emotional click. Consistency can beat panic. If you are considering an individual AI stock, do not only watch the price chart. Look at the business. Is revenue growing? Are customers actually paying? Is the company producing cash or burning cash? How much is it spending to stay competitive? And does the business depend on one product, one customer, or one big promise? A great story can attract investors, but numbers reveal whether the story is becoming a durable business. Be careful with loud predictions. The internet loves words like next winner, guaranteed, and before it is too late. But nobody can promise future returns. The louder the promise, the more careful you should become. A real investment plan does not need a dramatic prediction to work. It needs patience, risk control, and a clear reason for every dollar you invest. Do not hand your portfolio to the loudest person on your screen. What happens if AI stocks keep going higher after you wait? That is possible, and it can feel frustrating. But missing one fast rally is not the same as missing your financial future. New opportunities appear every year. The goal is not to catch every winner. The goal is to make decisions you can live with even when the market surprises you. Chasing something because it already moved can create a cycle of buying excitement and selling fear. Now ask the opposite question. What if AI stocks fall hard? Would you panic? Would you need the money immediately? Would one position damage your confidence so much that you sell everything? Your answers reveal whether your risk level is too high. Volatility is not automatically bad, but volatility becomes dangerous when you are not prepared for it. A plan is only useful if you can follow it when prices are moving against you. This is where position size matters. Even if you believe strongly in AI, you do not need to bet your future on it. You can decide what percentage of your portfolio feels reasonable for your goals and risk tolerance. Then stick to that limit. A smaller position may feel less exciting, but it can help you stay rational. Your portfolio should be built to survive being wrong, not just to reward you when you are right. Here is a simple approach. First, protect your emergency savings. Second, control expensive debt. Third, build a diversified long-term base. Fourth, decide whether AI deserves a smaller place inside that plan. Then invest regularly, review your position, and avoid changing your strategy every time a headline appears. This approach may not feel as exciting as buying the hottest stock today, but it gives you a better chance of staying invested long enough for your money to grow. So, are AI stocks too late to invest in? Not necessarily, but it may be too late to invest blindly. The difference is huge. AI can remain one of the most important growth stories of this decade. But a great story is not a substitute for a good plan. Do not buy because everyone is talking. Do not avoid it only because prices already rose. Build your decision around your timeline, your risk, and your financial foundation. The smartest investor is not the person who predicts every trend first. It is the person who stays calm when everyone else becomes emotional. AI may keep changing the world, but your financial future should never depend on one exciting headline. Learn the trend. Respect the risk. Invest with a plan. And remember, you are not late to build wealth. You are only late when fear starts making your decisions for you. Comment below, are you more worried about missing AI gains or buying at the top?